Hi everyone, thanks for joining us today. Today we're going to go over the third quarter market review for 2022. It's going to be from July 1st to September 30th. We're also going to touch on inflation and possible recession. We're hearing a lot in the news now. We're also going to go over investment implications and what that means for you as an investor. Third quarter was rough, so the NASDAQ was down about 30%, S&P was down about 20%, Dow Jones was roughly down about 13%. So here we're looking at the 60-40, where you have 60% equities, 40% bonds. It didn't do so hot either. It was down negative 6.8. You can see right here in the middle on the black bar. Positives were your managed futures. Those are up about 5.4. Those have been up on the year. But as I can say, this year in 2022, first 9+ months has not been so hot. Both stocks and bonds have been down. This is only the third time in about 100 years that stocks and bonds have been down at the same time. So we want to turn the page and move forward, moving into the fourth quarter. Some headline news, core and headline CPA. We're going to first touch on the headline CPA, which is the Consumer Price Index. And that, back in June, was right around 9.1%. You want to think of your food, toilet paper, keeping the lights on. This is your headline CPI. So in June, it was right around 9.1. That's for the inflation. It gradually went down to about 8.5 in July, 8.3 in August, and September numbers just came out, is down to 8.2. So it's not bad. It's slowly trickling down, but that's the big point, is it's going slowly. So inflation is still here and it's still running pretty hot. The core CPI, which is everything but your food, your water, your energy, it went from 5.9 in June and July. In August, it was up at 6.3. September is right at 6.3. So some of these costs have been going up. Even the food CPI, that's gone from 10.4 up to about 11.4. Going to the grocery store, Safeway, Target, Costco, I'm there every week. You can notice some food prices that are going up as well. Supply chain bottlenecks, those have caught up, so that we do have plenty of supply. And we did see energy, you can see back here in June, was at 41.5. That dropped down to about 23.8 in August. So that has come down. Hopefully it starts happening at the pump. That would be nice to see. Shelter component. So this is about 37% that makes up the headline CPI. We can see right here on the blue line, this is the shelter. So you're thinking, roof over our heads, whether you're renting. Most of us on the video watching here own a property. So the blue line, you can see it just went straight down, not quite straight down, went way down on the pandemic here back in 2020, and then rent and prices of homes have just skyrocketed. So the green line is going to be the home prices for this year. Pandemic, it went down, and then it's just been a large increase up. And home prices peaked right around May and June 2022. We're starting to see this little dip in there. And as we can see on the news, 30-year fixed rate mortgage went from 3% in January. Now as of last week, it's over 7% for a 30-year mortgage. That almost doubles your mortgage payment if you're looking to be a new home buyer. Some good news for those of us that are on Social Security: we will have an increase of Social Security next year in your COLA, cost of living adjustment, which is right about 8.7. And we have had 2 negative quarters of negative growth. News just came out earlier this week, so the third quarter was positive, so we are getting some traction. But as we can see, so right here, right in the big, greenish blue areas, the average expansion when markets are going up, when there's bull, it's right around 69 months. Okay. On the downside, when there's a recession, usually average is right around 10 months. So we're kind of getting to that 10-year mark where we're at now from January to October. So we're now talking about October. Recessions are painful. Eventually, we're going to move out of this and move forward and begin back in expansion. So it's all a cycle. Interest rates. So as we can see on the news, our cash, our money markets, our savings accounts are starting to get a positive gain on there. It's been like 14 years. So 1 year ago, I'm going to touch on a couple of these muni bonds, which we look for raising capital here in California. Muni bonds in your brokerage accounts are tax-free. A year ago, they were yielding just over 1%. They've nearly tripled, in the last 10 months, they're up to 4% now. For those of us who like those savings, on the fixed interest, a lot less volatility than stocks and equities, this is a very good deal right now. Even investment grade bonds, which loans from companies and businesses, those were yielding a little bit over 2% last year. Now they're yielding more than 5+%. Even high yield corporate bonds are up over 9%, and emerging market debt is over 7%. So for investors that like that bond ratio and like getting those payments every month, not a bad deal right now for bond investors. Want to talk about this? So the markets are always forward looking. They're looking a year, 2, 3 years out with earnings, and the economy is always lagging. So it looks from behind. And as we can see, this is just the normal cycle. And right now we're getting near the bottom of it. So market's going to peak. This could have been December, January, and slowly trickle down. That's the blue line right here. Your economy, that's right here as the green, it's going to peak, it's going to dip down. But even before the economy bottoms, the market's already shooting back up there. So that's why we want to stay the course, stick to your financial plan. You don't want to miss out on those gains. So since 1942, so we've got over 80 years of history here. Average bull market is about 4.4 years with an upside of over 155%. Feels pretty good. Average bear market is about 11.3 months with a downside of about -31. So we're right in there on those averages. And we got, baseball going on tonight. We got the Houston Astros against the Phillies, game 1 of the World Series. If we can hit 750, I mean, you're going to be, double an all-star on there. So if you can be right 3 to 4 times, kind of like how the stock market is, you're in smooth sailing. Okay. So 3 to 4 times is very well. It's just right now we're at the tough part of it. It's hard to stomach. All these funny lines here, I'm going to go over these. This is why we diversify. So back in 2007, emerging markets were positive 39. This is when the mortgage crisis was happening. A lot of defaults were going on in the news. 2008, emerging markets were negative 53. So there was an extreme high, extreme low. The reason why we build that diverse portfolio with your stocks, your equities, your bonds, alternatives, and real estate, so we can kind of get a smoother line here as we go through here with asset allocation. That's what this means. So it's, there's going to be winners 1 year, whether it's small cap or large cap or cash. It's very unpredictable. That's why we pick many different stocks and many different baskets to kind of smooth out that up and downs in the market. So just to recap, right now markets are down, both in the stock side and the bond side. Inflation is still high. We're going to see next week Jerome Powell. He's going to meet with his Federal Open Market Committee November 1st and 2nd. Most likely he's going to raise it, either 0.5 point or 0.75 point, and they're doing that to slow down the inflation. There's still a ton of people flying, spending money, going out. So that hospitality, it's still growing, that service industry here in the US. So we're trying to tighten that up. And even though the investment landscape is challenging, right now is a good point to get into stocks. So stocks are on sale. And for those of us that are more risk averse, it's a good time to look into some bonds, cash and CDs, because those are paying interest rates now, which is nice to see. Thank you all for watching. See everyone soon.